Good morning. This is Dylan Jovine with Behind the Markets. Happy Wednesday. Today is Wednesday, April 29th. And yesterday I talked about the rise of CPUs and the new ratio and relationship between CPUs and GPUs. I'm affectionately calling that the Empire Strikes Back. Intel takes back from NVIDIA a little bit of the AI narrative. But today I'd like to talk about the market sell-off. So we have a situation where one day, for the last 30 days, it's been going gangbusters. The last 2 days, the market sells off. Yesterday, sells off pretty bad. Oracle famously is down. And it's interesting, when you get to this phase of the tech rollout, a new technology, it's riding a mechanical bull. That's what this old timer used to say to me on Wall Street. You don't know which one's going to every day. It's you're up, you're down, you're up, you're down. It's crazy. So why is the tech sector suddenly selling off? It almost seems bipolar. It's really driven by OpenAI reporting from the information, the Wall Street Journal and other sources saying that OpenAI missed an internal revenue target. And I have some notes here. I'm going to reference them. They missed their goals, an internal revenue target, an internal revenue goal during the first quarter, according to a person with knowledge of the situation is obviously leaking, after the company's ChatGPT previously missed user growth goals. So what it is saying basically is that OpenAI's ChatGPT isn't growing as fast as was expected and what the company is bet on. And really that's because of stiff competition from Google's Gemini chatbot, which really boomed in the fourth quarter last year. And as a user myself, I saw a big difference. Google really jumped up there. I talked about it in these videos. Anthropic, which seems to have the first quarter of this year, and it's a very tight race, and every single quarter, different companies have momentum, and very clever public relations for Anthropic to release Mythos to government agencies, which by some accounts is very similar to ChatGPT's recently released last week, 5.5. So it's very, very clever PR. Anyway, the internal revenue miss does not mean the company's going to miss its revenue target for 2026, which is $30 billion, up from around $13 billion in 2025. And the company also says it's expected to burn $25 billion this year compared to an $8 billion cash burn last year. So why would OpenAI's miss spark a tech sell-off, especially with Oracle? OpenAI's obligations, you've seen them signing all these deals. Every day it's a new deal. It's this, it's that, buying data here, buying electricity and power there, et cetera, et cetera. They stretch well beyond the $600 billion figure that most headlines talk about. Really, there's a site, a blogger, The Decoder, and I'm going to butcher his name, Tumash Tungus. He's very good at writing. He seems to have his finger on the pulse, seems to really be plugged in. And he runs a site called The Decoder, which is really focused on the inside scoop on tech. And anyway, according to his reporting, OpenAI has committed roughly $1.15 trillion on hardware and cloud infrastructure between 2025 and 2035, broken down across 7 major vendors. Broadcom, $350 billion. Oracle, $300 billion. Microsoft, $250 billion. NVIDIA, $100 billion. AMD, $90 billion. Amazon AWS, $38 billion. And CoreWeave, $22 billion. So what the market is saying, when you get to valuations like this, which are very, very rich, investors have this shoot first, ask second attitude. The hint of something going wrong, they run away because these companies are being priced for perfection. That's what we mean when we say priced for perfection. This stock is priced for perfection. It means that it is priced as if everything is going to happen perfectly. I don't know about you, but I've been alive long enough to know that's just not the way the world works. Nothing unfolds perfectly. No plan survives first contact, or as Mike Tyson says, everyone has a plan until they get punched in the face. Anyway, so a lot of people running from those stocks, many of which have been priced for perfection. So this is a scenario where you see potentially a domino falling. OpenAI growth slows, revenue target slows. They're not able to meet their spending commitments, and then goes bang, 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 and hits all these other dominoes. Oracle, Broadcom, less storage, less cloud, less chips. Dominoes fall all down the line, which impairs the businesses of those particular companies. So this is a developing story, obviously. This is early reporting. The journal broke. And this is something we're going to keep a very big eye on because, again, when you're priced for perfection, lots of crazy things happened. And it speaks to what happened, what we talked about yesterday. AMD up 70 some odd percent, ARM Holdings up 70 some odd percent, Intel up even more. Well, Intel certainly was revaluing itself because it was in the doghouse for so long. But ARM and AMD have just been going crazy. Almost, if you look at the charts, it's been straight up. Ladies and gentlemen, I hate to disappoint you. I'm sure you know this at this point in your life. Nothing goes straight up. Things have to get repriced. When it goes straight up, it should come down. In classic technical analysis theory, which is not something that I use to buy companies, but I'm just telling you that the humans watching these stock charts think of it this way. In classical technical analysis theory, it should come back. When you see something go straight up, it should come back about a third, consolidate its base, and then either march higher or march lower. Anyway, that's all I have for you today. Have a wonderful day. I will see you tomorrow.